Wondering what's going on in the housing market in Las Vegas in 2024? I'm going to go over the details of how we wrapped up 2023, which is really important, and where we're going in 2024 based on not only all the data that people are talking about, but we're also going to be talking about what the first 2 months have brought to us so far. There's a ton of data to go over, and there's a ton of ways to look at this, and I hear all of it. I hear some agents and economists that are saying, hold up, don't do anything, the sky is falling, and I see other people saying, no, the market's still going crazy, go ahead and buy before it's too late. Sometimes you're probably thinking, oh, these people just want to sell houses. And sometimes you might be thinking Chicken Little over here saying, oh, the sky is falling. However, what if I miss out on an opportunity? What if I don't buy and they do continue to go up? So how do you sort through all of this information and make it make sense for you? That's exactly what we're going to talk about today. This is Alex Rivlin with the Rivlin Group, and I really want to go over the details of it in a really a non-biased way, so that way you can see and understand exactly what's right for you. The way that I see it, there are some people that should move forward and go ahead and sell their home or buy a home right now today. There are others that probably shouldn't, and we'll go over some of those details. So this is not your normal monthly market update. This is actually going to be a full-blown recap of 2023, where it looks like 2024 is going, all of the economic data that comes along with it, so that way you can make the right decision for you. If you have any questions about what I'm talking about on today's video, go ahead and comment below. I'd love to answer it for the entire audience. And if you have a specific question just related to your situation, there is a phone number and an email below in the description section. Please reach out. That's what I'm here for. I love hearing from all of my potential clients, and even if you already have a great real estate agent that you plan on using, I would still take pleasure in answering any of the questions for you or even for your agent. I am a student of data. I geek out with numbers. I absolutely love them. And that's what I go through. So we're going to share some things on the screen. We're going to go over a number of different details that are really, really important because they make a big difference to how we're going to make decisions. So here we go. Let's start with how many homes were sold in 2023. There were actually 29,000 homes sold here in the greater Las Vegas area in 2023. Now that is all resale homes. There were also new homes sold, and the new homes pale in comparison in regards to the overall number of sales when it comes to actually sold homes for the year. If you compare that with prior years, you'll see actually how deficient that is. That is an incredibly low number. You can see on this chart, we're going all the way back to 2014. And if you look at the top line, which is the single family homes sold, and then in the section below, the top line of the condos and townhomes that sold, that combined would show you what the sales for the year are. Now this dates all the way back to 2014, and there have not been lower sales than last year on this entire sheet. We're going to go all the way back to about 2008 to have that number, that 29,000. Now, a couple interesting things. 2008 was right after the crash, right? So everything had locked up. Lending had frozen. People weren't able to get loans. And back in 2008, the population was between 1.6 and 1.7 million people. So if you just simply look at that difference, right, we have about 50% more population, and the sales have never been lower since then. Now, let's just look at the last couple of years, and we'll talk about some anomalies there as well. So last year was about 35,000 home sales, again excluding new homes. And the year prior to that, in 2022, that number was about 35,000 homes. As I mentioned, we're still excluding new home sales. And when we go to 2021, the hottest year on record, we were over 50,000 home sales, still excluding new homes. So you could see what the difference is. Now, I mentioned I was going to talk about anomalies when it came to that as well. And 2021 was certainly an anomaly year. There was definitely a fear of missing out kind of mentality. People were overbidding for homes. Any home that they could get, they were taking, and the world was just in a frenzy, especially in a place like Las Vegas that has such heavy population growth. And in the midst of COVID and remote working, we had a lot of people from California, as we always do, but even more, coming here to buy a primary residence. That is an anomaly year. And while I do expect years to come out like that again, it's because of population growth and other factors that are coming into play, not just because of what was going on there in 2021. If we didn't have COVID, we didn't have some of the scenarios that we had, some money being granted out, and the variety of other things, the captivity, the remote working, we likely would have been in a situation of having somewhere between 40 and 42,000 homes sold in 2021. So you could look at this chart, you could add up the two numbers between the single families and the condos and townhomes, and you could see that we were trending in that 40,000-ish range, and that should continue. Now, why did we drop down to 29,000? Right? We're all wondering what that is. No, most of you probably aren't wondering. You know exactly what it was. It was the economy having an impact where interest rates were increasing and we got into the high interest rates. Now, what did that do? That did two different things. There was a mental element and a reality element. The reality element is pretty easy to see. It knocked many people out of affordability. They were looking for a particular type of house. Let's say they had a family of 4 and a dog, and they wanted to make sure that they had a minimum of a 3-bedroom, 2.5 bathroom, and they looked at that home, and that home was a $500,000 home. And now with these new rates, it was $700 or $800 more than it would have been previously. Now, as a result of that, it knocked them out of affordability. When they went to the bank, and they got all those ratios that are acronyms like DTI or debt to income, that showed them that they could actually only afford a home for $380,000. When they looked at what they could get for $380,000, it wasn't feasible, and therefore they made the decision to continue renting and not buy right now. Now, there's some arguments as to, again, the what and why and should and what was the appropriate response to that. Should I have bought and paid a higher payment? Should I wait and continue renting? And we can go over all of those details. However, they really are specific to the person. So I'm not here to tell you that, yes, you should absolutely be buying because, well, if the home market continues, you could always refinance. You've probably heard this term of marry the home and date the rate. Well, I think that's a lot of rubbish, because ultimately it's really your decision and it's depending on your specific scenario. There are people that are in homes for 2 years, 3 years, 4 years, and then those that stay in homes for 7 or 10 are kind of crazy people like me at 24 years in the same home. And there's going to be a big difference in regards to that. If I know somebody's going to be in a home for 20 years, then yeah, buying now may actually make a ton of sense. And you don't have to be in 20 years for that. Don't get me wrong. I don't want to make it sound like that's the only way that it makes sense. It makes sense for a lot more people than it actually doesn't make sense for. However, it is your specific situation. So we'll go over a few of those details as well as we continue on with this video. For 2024, we've actually started to increase the sales just a bit. Now, we started out in January with 2,147 closed sales total for the Las Vegas Valley, and that includes the condos, townhouses, and everything. So if you look at that and extrapolate, that would only be a little over 25,000 for the year, so it doesn't look that great. We know that that is historically the slowest closing month because we just got out of the holidays, right? We had Thanksgiving, we had Christmas, we had New Year's, and those are the slowest shopping seasons. Now, that doesn't mean for those of you that are ever looking at listing a house in that season that you shouldn't. While buyer activity drops, so do listings, and oftentimes they don't drop in parallel. Oftentimes the listings actually drop even more, and some of the buyers don't buy during that season because they can't find the listing they're looking for. So you actually have an opportunity to list during that time because there's less competition. Now, are you going to have less visitors? Absolutely. However, as long as you have enough visitors to find that right buyer that's willing to pay you the maximum value that your home should demand in the market, then you're going to be well suited. So if you have a good agent that really understands the strategy, then listing a little before New Year is actually oftentimes good, because a lot of people are waiting till after the New Year to list, and then the market could quickly get flooded with competition. And if your home, let's say it's a fantastic 8.5 on a scale from 1 to 10, well, every other 8.8, 9, 9.2, and 9.5 out there is going to be what's going to go first when it comes to that competition. And again, if you have 10 more homes out there, and previously there were 10 homes and now it doubled to 20, and the buyer pool went from, let's say, 30 people and it only went to 40, it's not relative, right? You don't have double the buyers for double the homes, and therefore you're actually in a slightly worse off situation. When it comes to that, if you're talking to an agent and they're talking to you about when to list, and again, we're early in the year, so this won't happen for you right now. However, if you're a homeowner and you're thinking about listing anytime in the future, in a year, 2 years, 5 years down the line, and you're thinking that there's a good reason not to list around the holidays, then you might want to rethink that decision. Now again, it's a personal thing. If you have relatives over, if you're the host of all the family dinners throughout the holidays, then having your home listed may be very, very inconvenient. And therefore, it might not be worth the fact that you can get a couple or a few $1,000 extra by being a more demanded house, by affecting the supply-demand curve. However, if that's not the case, again, that's where you might want to rethink exactly when you list to be the most strategic to the outcome that you're looking for. With the anomaly of all of the sales through 2021, we did reach our peak median home price in May of 2022. So we came off of that tailwind from 2021. We were still pushing into 2022 before we started seeing all of that rate disruption. And that's when we hit that peak, and we started going down right after May of 22, very, very slightly into June. So our peak was $481,000. That is for a single family residence in the greater Las Vegas area. By greater Las Vegas, that does include Mesquite, Pahrump, Laughlin, Boulder City. So you've got a little bit of a mix in there. So if you were able to take that out, we might have been a little bit higher just in the Las Vegas metro area, so to speak. So we started going down, and we actually hit our bottom in December of 2022. And then it was even for 4 months in a row, all the way through March of 23, where that bottom was $425,000. So when you think about that as a percentage off of $480,000, so we were just shy of 12% off of our median peak. Now, as of February of 2024, we are at a median price of $460,000. If you happen to look at the average, we're actually a little bit closer to the peak than the median is, because we're looking at actually what's sold and what those prices are. So with the idea that the median is a little bit lower, maybe there's just a few more lower price properties or a few less high price properties that are on the market this month versus some of the months in the past, and that's throwing those numbers off a bit. So when we look at averages, they're actually a little bit tighter than the difference between the 481 peak and the 460. However, you could still see that things are looking pretty strong. Now again, let's go back to what I mentioned, which is the anomaly. That 481 was during an anomaly situation. This is a time where homes were being overbid. People were paying $20, $30, $40, $50, $100,000 over what the homes were valued at. So if we take away all of that overage, all of that fear of missing out, all of that pent-up demand and fear and every other emotion that went along with what was going on at that time, then the homes actually would have been a little bit lower. They would have probably been trending somewhere in that 450 range. And instead of on this graph where you see this spike going up really high, almost hockey stick-like, if we just take a gradual line and go across like I've done here, you can see that it really follows the trend line in this entire graph. That's a 10-year graph. As a matter of fact, it's still actually a little bit steeper as we get into the years that are closer to now than they were even from 10 years ago. Now remember, 10 years ago, we were still in a low, right? 2011 is when we hit our bottom here in Vegas. So looking at this graph from 2014, we were still in recovery mode. So we had actually some really good gains in those years. So to think that if those gains were going up at if those were going up at say a 10-degree angle, and now we're going up at a 12-degree angle, well, that means we have a lot going on here. Now you may be wondering what it is that has this market going. And you may actually know a lot of them. That's what it is. It's a lot of different things. It's a culmination of so many things that are going on here in the city. One is simply that we are graduating as a city, right? In 2017, we announced our beloved Vegas Golden Knights, our NHL hockey team, and yes, Stanley Cup winners, go Knights go. Then we got the Raiders. Now we're getting baseball. We already had WNBA, and again, the world champions, Las Vegas Aces, so go Aces. And it's extremely likely that we're gonna get basketball here soon. Almost any major city that you think about has professional sports. Bringing professional sports here really helps us in so many ways. Not only is it great entertainment, but it brings a great medical community. It brings other high-paying jobs. It also diversifies industry, so we're not so dependent just on hospitality and gaming. When you look at that, that in of itself has quite a draw. We also, as you likely know, have no state income tax. Therefore, there are people moving from California in droves. And when you really think about the numbers, it's pretty mind-boggling, right? I mentioned earlier that we have about 2.3 million people here in Las Vegas. California has about 40 million people, and the majority of them are in the big metro areas like San Diego, Los Angeles, and the Bay Area. And those are also the high dollar areas as well as high taxed areas. It doesn't take many of those people to want to move to Vegas to have a big impact on our population and a big impact on our housing scenarios here, because they're coming from a place that they were at $1 million, $1.5 million, $2 million for fairly average home, and what they could buy here for that is so much more. So when that money comes into play, again, the supply-demand issue really goes a little bit askew. And with that population differential, there's a lot to continue coming. Now, you know, if you could think about it this way, if we were 2.3 million people and all of California was, say, 7 or 8 million people, that wouldn't be that big of an impact. However, because it's so many people, all you need is 1 or 2% of California to say, I want to move and choose Vegas as their destination. And it is enormous to the Vegas market. Because, well, 1% of California is 400,000 people. That's a 20% growth nearly to our population. Now, I'm not saying that that happens every day because, well, it certainly doesn't. We have about 4,000 or 5,000 people moving here per month. We're not talking about 1%. But again, I'm giving you this for illustrative purposes so you could see how easily impacted things are and why the housing market tends to stay so strong here through the turmoil that we've been enduring over the last couple of years with the fluctuations in rates and uncertainty in the economy. Which leads us to the overall homes for sale. So you can see that this graph is all over the place when it comes to homes for sale. It goes all the way back to 2014. So as you may recall, I mentioned that 2011 was our bottom here in Las Vegas. By 2014, where you start seeing on this graph, we were coming out of it really strong. Loans were plentiful again. We were able to get people financing. The hedge funds were buying. Everything was going on. And we still had a lot of inventory. There were a lot of people still selling their homes, some that were foreclosures and short sales and, you know, the whole gamut of just trying to get out of a home. However, the majority of them were just everyday people looking to now sell their home. Fast forward to today, and again, you see these ups and downs, and you see that bottom, that the lowest number historically ever for us was about 3,500 homes in February of 2022. Now, that was the lowest we've seen pretty much in the history of Vegas, except for when it was back, you know, say sub 1 million people. Now we look at today, and we had a peak when the interest rates went up. And now that's really dropped down, sitting, as you can see on this graph, at just over 4,100 homes for sale in the market today. Now, what does that actually mean? One of the things that I hear a lot regarding what we call the inventory, the homes on the market, is that sellers just aren't willing to list their home. Why is that? Because they're in at, say, a 2.5, 2.75, 3, 3.25%, 3.5% rate. And therefore, the idea of moving, whether they're upsizing or downsizing, just doesn't make sense. Let's say they're downsizing and they have an $800,000 home and now they're looking for a $600,000 home. They go ahead and they sell their $800,000 home. Now they've got nice equity in it because they get to appreciate the gains that we've had over the last few years. And they put a good down payment on it when, to begin with. Let's say they did a 20% down. It was back when the home was $600,000, so they've got $120,000 that they had put down. They've paid it down for several years. Maybe they've amortized down another $30,000. So they've got $150,000 in their original down payment plus what they've paid down, and now they've got $200,000 in the gain. So they've got $350,000. Now let's take some fees out of that. They spend $50,000 between some commissions, transfer taxes, escrow fees, everything else, and they're sitting on $300,000. They want to downsize and they go from their $800,000 house to a house that now costs $600,000 because let's say their child graduated high school, they're off to college, and now they don't need the extra room. Now they're looking at downsizing to that $600,000 home, and they're going to put $300,000 down on it. And the $300,000 balance, well, their payment is only $200 less than the payment that they're in right now on this home that's worth $800,000. Is it worth saving $200,000? Some would argue no, and that's why they're not selling their home. Other people that want to upsize, well, they were looking to upsize by $200,000 or $300,000 on their home, and they were expecting that their home payment would go up another $800 to say $1,500. However, because they're having to actually finance the entire upgrade cost plus whatever their current loan was, maybe they're putting a little more down on it because of, again, some equity. However, they're still going up that $300,000 in their overall loan. The base loan, which was at 3%, and the upgrade loan are now all coming in together because they can't carry that loan forward because they're selling that home. And instead of, say, a $1,500 difference, they're actually facing a $2,800 difference. So do they wait? Well, many are choosing to. However, the argument that the inventory is an issue because sellers aren't listing is something that I really want to dispel. And why I want to dispel that is because there is a net zero or close to a net zero in that. So for instance, we have 4,100 homes on the market right now. If we all of a sudden had another 4,000 sellers that said, you know what, interest rates don't matter, I'm going to go ahead and list my home. Well, now all of a sudden we have 8,100. And that seems great, right? We almost doubled the inventory. However, what we did was we also put 4,000 more buyers in there. So that's why I mean it's a net zero, because they're going to go and take other homes off the market. So it just becomes a swap, right? We just swapped home A for home B, and now that's off the market, and we're in that same situation. Now I said almost a net zero because some of those 4,000 may have actually had plans to move out of state. Maybe again, their kids are out of the house, they're empty nesters, they can work remotely, and they want to move to the beach. They're going to go to Boca Raton, or they're going to go to Texas, or they're going to go to Nashville, Music City. They want to change in their life. They're in a different season of their life, and that's what they're willing to do. The majority are looking to stay here because they have some sort of ties here, whether it's work, children, family, friends, whatever it may be, majority are staying here. So even if that number was a 95.5 number, even if it was a 90.10 number, okay, so we have 400 more in inventory because we had 4,000, but again, 3,600, 90% are staying here. They're going to take some other inventory off the market. 10% are leaving or decide, you know what, I think the market's going to go down, or whatever they may be telling themselves, and they're going to rent in the meantime. It's not that big of a deal. So we're still going to have an inventory issue, which is where we come to something that we actually call our inventory and how many months of inventory we have. So on this next slide, you can actually see that we have 1.8 months of inventory. What that simply means is how many homes are on the market, and that number is divided by how many homes were actually put under contract or accepted an offer this week. In easy numbers, if there were 4,000 homes on the market and 1,000 homes were actually put under contract, accepted an offer this week, that would be 4 weeks, or approximately 1 month of inventory. Again, going back to that last example, let's say there were 8,000 homes on the market because 4,000 new sellers decided to sell. Well, they're all out there shopping, and let's say for some of them it takes 1 week, for some of them it takes 2, some 3, and some 4. So we're basically knocking them down to a quarter per week. We already had 1,000 buyers. Now we have 8,000 homes. We already had 1,000 buyers. And with this new pool, we just added another 1,000 that went under contract. So we have 2,000 that went under contract with 8,000 in inventory. We have that same exact 4 weeks of inventory. So you can see what I'm saying now. When it comes to new listings, it doesn't necessarily mean more inventory. It just means more homes on the market, a little more to choose from. However, a lot more competition, and the supply-demand ratios stay the same, and that's why pricing under a scenario like that doesn't really get impacted and knocked down. There's a lot of information to unpack in everything that I just said, and here's what we'll wrap up with. 2023 was a bit of a rough year for the real estate market here. However, the stability and the resilience that we saw in the market should lend a lot of confidence to people that are looking to buy or sell in a market time like this. 2024 is already showing better signs of life. While the Fed got a little bit shaken with the results of the last CPI, Consumer Price Index, and PPI reports that came out recently, they still are edging towards lowering the Fed rate. Now, that's not a direct reflection on the mortgage rates. However, it does have a pretty strong relevance and relationship to it. So therefore, we'll see the mortgage rates go down as well. We don't always see them correlate. We've actually seen the Fed rate go up sometimes with the mortgage rates dropping, because it's about confidence and the banks knowing where things are going, and are we headed towards a recession? Are we headed towards a depression? Are we headed towards stimulation? All of those things will make a big, big difference when it comes to exactly what the banks are looking at. And that's why you might see a little bit of a variety or divergence in those rates. That said, as the rates start to stabilize and inflation continues to drop, that's where we will see mortgage rates go down. With that, what we're going to see is more people enter the buyer's market. Why is that? Well, I mentioned earlier that that person that was qualified for a $500,000 home is now qualified for $380,000, and they can't find anything. Well, when that person qualifies for $420,000, $450,000, $500,000 again, now they're back out shopping. So the rule of thumb that the economists say is that for every 1 point that interest rates drop, it qualifies 5 million more buyers on a national basis. That doesn't mean there's 5 million more buyers. It just means that's how many are qualified. So how many are shopping at any given time? Well, we have about a 60% home ownership rate in this nation. Home ownership retention is for about 7 years, right? How long you retain your home. When you factor all of that in, that 5 million becomes 3 million. That 3 million under a 7-year scenario becomes about 400,000 or so. Now let's relate that to Las Vegas. We have a growing population, people moving here, and our population is about 0.67% of the overall US population. Doing the quick math on that is, if we had 400,000 buyers, then that would be somewhere in the area of about 3,000-ish buyers that would be qualified right now here in Las Vegas. That would be looking to buy a home. When you look at that 3,000 buyers and add them to the pool of existing buyers that are keeping this market very, very stable, when there's only 4,000, just over 4,000 homes available, that becomes an issue, right? Now we don't have enough inventory in order to actually keep up with that demand, and that will drive prices higher. Do I expect prices to start to hockey stick again? I don't. I think we're going to be pretty stable. I actually am in agreement with a lot of the economists that are talking about somewhere between 2 and 8% gains over the next few years on an annual basis, not the total over the next few years. However, I do see that we're going to go up. So now this comes down to, what is the position, what is the season of life that you're in, and what is important to you? Now, if you told me today that you were only planning on staying in Vegas another 2 to 3 years, I would say it's not a good idea to buy a home. However, if you're planning on staying in Vegas for a longer duration, 4 years or more, and you have the stability to stay in a home for 4 years or more, what's going to happen is you can find the home now without massive competition. And by the way, we are still seeing multiple offers on great homes. We are seeing homes that are going on that first weekend that they're live. So there is certainly some competition. I know some of my buyers have certainly lost out, and we like to pride ourselves here on being very strategic on how we place offers and making sure that we get our offers accepted more often than most other agents, and we still get offers rejected right now in this particular type of market. That is likely to get a little bit harder and a little bit worse for a lot of people as rates go down. The idea that you could buy a home right now and maybe be in a rate that's slightly uncomfortable for right now, and then refinance again as long as you're going to stay in that home for 4 years or more, it will oftentimes work out in your favor over that time versus waiting, having the home prices go up just a little bit because you'll spend a little bit more just there. So let me give you an example on that. If hypothetically right now you had to spend $600 more per month on a home, so that's $600 per month times a year is $7,200. And let's just use a year from now. You were going to wait and you were going to buy that home now in a year from now. The likelihood of that home, say a $500,000 home, going up 2% and being at $510,000 is extremely likely. That same home, there might be 3 buyers looking to buy it then, where right now maybe there's just you or maybe one other one, so competitively you can get that better offer in and get that home purchased. Now I know it's hard to look at it like that sometimes because you're still looking at that higher payment, and that really just doesn't work for my monthly. Even though you may qualify for it, you're just looking at all of your other bills. So there's another way to look at it, and that is the investment way. And frankly, it's the way that I've looked at a lot of things in my life. For instance, when I started off in business years and years ago, not even in real estate, I really needed an assistant. However, when I first looked at the assistant, I looked at how much that assistant was going to cost me. I looked and I said, okay, an assistant part-time was going to cost me about $1,500 per month. And I said, I'm looking at my revenue. I don't have $1,500 per month to do this with. And so I was stuck in a vicious cycle. I needed the assistant in order to grow, in order to build my business. I didn't have enough revenue coming in to hire the assistant, right? The ultimate paradox. What I ended up doing, and it was through some great mentors that taught me this, was looking at it as an investment. And they said, Alex, if you were going to invest in a marketing plan right now, or you were going to go on an epic vacation, do you have any money to do anything like that? And I said, yeah, I've got some savings in the bank. And they said, how much could you afford to give up right now without totally sweating it and impacting your life? And I said, probably around $5,000. And they said, okay, so instead of looking at it as $1,500 a month against your actual revenue, they said, why don't you look at it as you're going to invest $5,000. That's going to give you 3.5 months, give or take, to hire this person. At the end of the 3.5 months, if that person is justifying themselves, then it was an investment, not a cost. And now you have that $1,500 per month coming in to continue paying them in month 4, 5, 6, and beyond. Now you just have your investment and you've got to repay yourself. But as things continue to grow, that offsets and you've paid yourself back maybe by month 8 or 10 and go from there. So I did that. It's worked out really well for me. It's a similar methodology. It's obviously not in business. However, if you said, okay, if I paid the extra $600 and again, let's say it took a year, so you've invested that $7,200, and let's say in a year you were able to refinance and drop that mortgage payment by whether it was $300, $600, $800, whatever that number is. Well, then you've done that, and the home's been appreciating during that time. So you're actually paying yourself back, at least on paper, maybe not out of your pocket. So now it's a matter of what can you afford in that investment? Could you actually afford it at that $600 a month, even if it would be a little bit of a constraint on your life or your lifestyle, or maybe burn into your savings a little bit? And again, I'm not promoting that you do this. It's just a way to look at it to make a decision, is now the right time for you? I believe that 2024 is going to be a great year. I'm very much expecting us to get back up to 35 to even as many as 40,000 sales this year, depending on where rates go. But I think 35,000, unless there's some sort of anomaly that I'm not expecting that really, hits us out of left field, I'm expecting a very, very positive and bullish year. We have more people moving here, and they're looking for homes and keeping that housing market strong. If you have any questions at all about the Las Vegas housing market, about some of the things that I talked about that are just in the economy, or anything Las Vegas related, from sports teams to what's the best restaurant in town to go to for your anniversary, I would love to hear from you. You can call me or email me at the number below in the description area. I would love a thumbs up, follow me for more videos, and definitely comment. I would love to see your questions. Even if you disagree with what I'm saying, go ahead and comment. I would love to see it, because I'd love to see what your perspective is and answer it. Or if it's not something that warrants an answer, I'm still going to reply to you and thank you for that information. So thank you so much. This is Alex Rivlin with the Rivlin Group, and we'll see you soon.